6 months ago, I took office amid the worst recession in half a century. We were losing an average of 700,000 jobs per month, and our financial system was on the verge of collapse. It's an economy that simply wasn't ready to compete in the 21st century.
The Great Recession of 2008 was a dreadful event, affecting millions, which in turn changed the way we see our economy today. A recession is defined as 2 consecutive quarters of negative economic growth, as measured by a country's gross domestic product, or GDP. According to the Bureau of Economics Analysis, the U.S.'s GDP was reduced by $460 billion within 2 years.
The recession was caused due to the buying up of real estate and housing with low-interest loans called subprime mortgages.
A subprime mortgage is a loan given out to those with poor credit histories, involving no signatures or paperwork, and not ensuring that the recipient is able to pay them off.
Subprime loans were the loans where we used to say if you could fog a glass, you could get a loan. My name is Gary Manus. I'm a real estate broker. I have a company called Metro Brokers, Manus and Associates in Littleton, Colorado. Subprime loans were things like, they also went by alternate A loans. They went by ninja loans, where it was no income, no job, and no assets, so they were called ninja loans. But they were subprime because prime borrowers had great jobs, great assets, great income verification, good credit. The loans that you're asking about, they didn't hardly have to qualify. They didn't even really have to have a job. You could just state that you had a certain income and get a loan.
Due to the ever-increasing home values each year of between 5 to 10%, lenders would make more money selling the house after a few years than they did collecting on the subprime loans.
In order to make more money, these subprime mortgages were bundled up and sold out to various investment firms.
When a bank, like Wells Fargo, for example, when they do home loans, sometimes if they don't keep them in-house and keep them in Wells Fargo as financing, they bundle them and then they sell them out to investors. And that's fine if everybody in that package is all paying their home loan. Unfortunately, the problem was that house prices dropped and people lost their jobs, so they weren't making their house payments.
As the law of demand states, when price increases, quantity demanded decreases. This was especially true to the elastic price of homes. When a home gets too expensive, less people will be able to afford to live in it. This is precisely what happened in the Great Recession.
Back in 07 and 08, especially 06, that kind of peaked in prices. Everyone just anticipated and assumed that prices would just keep going up. That's one of the reasons people could get loans with nothing down, because the banks thought, well, I can do that because 5 years from now it's going to be worth 20% more, and I'll still be fine as a lender. The prices didn't go up, and as a result, this price that everyone thought was just inflating, it just literally burst. And that's why kind of they term it as a bubble bursting.
Many individuals did not think of the consequences of buying a house they wouldn't be able to afford, and because of this, many ended up foreclosing.
According to the Mortgage Bankers Association, between 2005 and 2009, there was a 215% decline in new home builds, a 358% increase in home foreclosures, and a 33% decline in residential construction employment.
Because of this, many banks were reluctant to give loans, and it became very difficult for an individual to refinance.
The high price of real estate and the rapid foreclosure rate led to the downfall of investment firms such as Lehman Brothers and Goldman Sachs.
Banking certainly, 2 or 3 major banks went out of business completely or got sold to a competitor for pennies on the dollar sort of thing. AIG lost a ton of money, billions of dollars a week. So
with this, we saw many banks, such as Washington Mutual, Wachovia, and Merrill Lynch, closing because of their faulty loans.
So all in all, it wasn't too good for much of anybody.
Due to the sudden decline of the economy, the federal government was forced to intervene, assuming great control of the free market.
After the Great Depression, the U.S. saw more than 40 years of economic growth due to smaller banks and tighter government regulations of mortgages and loans.
I'm sure last year I had my second best year ever, though. Had a buyer last week. We made an offer on a house that had just come on the market, and they had 13 offers. So we're seeing that kind of thing coming back, where multiple offer situations, people paying even above list price, So yeah, I think the industry right now is very strong, and everything I read for the next 3 or 4 years indicates that we're going to see a 3 to 5% increase in value.
We believe that in order to avoid a future recession, government intervention must be allowed to a minor extent.
We've seen 2 big recessions, 2 other ones besides the one in 08 and 09, and they were kind of driven by banking too. So it seems like sometimes if they loosen those controls and don't keep regulation, I could see the banks getting a little greedy and causing problems again.
The government must enforce more strict laws on the policy of loans, those in which people will not be able to buy what they can't afford. People should also be more aware of the spending. If we all work together to spend our money wisely, we can all make our government and economy more stable.